Greetings, it is time for our monthly inflation update, and we're going to take a different format this time because I'm going to combine a concept that I introduced in another type of video from last month. But at any rate, we start with our three major inflation measurements to create a combined holistic view of inflation. This way we get around any objections that claim that the US CPI understates inflation and other such easily debunked beliefs, as well as a fixation on short-term numbers, which we'll also look at later in this video as to why that is futile. So as always, the measurements are the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index. This is the most important measurement of the three because this is both worldwide as well as an index of freely traded components such as gold, oil, natural gas. Therefore, it cannot be rigged. This whole narrative that inflation is understated is entirely destroyed when you use the Goldman Sachs Commodity Index. And then lastly, the 10-year US Treasury yield. This is not a measurement of past inflation, it is about expectations of future inflation, but it has a tremendous impact on the real estate market. So we'll go to the Goldman Sachs Commodity Index first. Flying through this really fast, we can see that the 10-year compound annual growth rate of the Goldman Sachs Commodity Index is minus 0.55%. Minus 0.55%, which means deflation. For all this talk of inflation, there is outright deflation in commodities, which is the most important of the three measurements. Next, we go to the 10-year US Treasury yield. This is the 10-year US Treasury yield, one-year chart, and it's 3.50%. And as I've often said, it's very hard for this to stay above 3%. It is comparable to holding your arm horizontally to the ground and seeing how long you can hold your arm up like that for. It shot above 4%, but it couldn't stay there for very long. It has dipped back down to 3.5% because this is extremely negative for the housing market. And once the housing market starts to weaken, there's pressure on this to weaken, as well as all other inflation measurements to weaken. But this is the one that happens to be above 3%. Lastly, we go to the US CPI. US CPI from the bls.gov website. So to calculate the 10-year compound annual growth rate, you would take this number, 298, divided by the number exactly 10 years prior, which is 231. That shows 29% inflation over 10 years, which comes out to 2.6% a year compounded over that 10-year period. If you want to see the arithmetic about how that is done, look at prior month videos. But I want to fly through this because we don't want this video to be too long. So we take all three of the measurements we just looked at, and this is what we come up with. Today, on December 14th, 2022, the 10-year compound annual growth rate of the US CPI is 2.6%. The 10-year compound annual growth rate of the Goldman Sachs Commodity Index is minus 0.55%. Commodities continue to be in deflation as we would expect from the atom thesis. Technology continues to increase the supply of commodities at a rate faster than demand. And the 10-year US Treasury yield is 3.5%. And remember, inflation is problematic only when all three of these measurements are above 3%. All three have to be above 3% at the same time for inflation to be structurally high. And as you can see, only one of these three is above 3%. The others are not, and the Goldman Sachs Commodity Index is in deflation. It is nowhere close to 3% and doesn't look like it could ever get to that type of measurement. So no, inflation is not high at all, despite the narrative in the media. Remember, inflation sells, and the media makes money by making you angry or frightened, and they want to keep you in a state of anxiety because we're getting so many contradictory headlines. The fall in oil indicates a weak economy. So until the day prior, they were saying inflation is bad. Now a fall in oil prices is also bad. Their only constant is saying that everything is bad news. But this is the inflation scorecard, and I want to take you to a new type of table that I've introduced because people have an extremely short-term memory as well as an extremely selective window of data that they choose to look at in order to support a bogus narrative. So here we are back at the CPI measurement at the bls.gov website. In addition to the absolute CPI, we look at the growth rate over the various windows that can be measured. This is the 1-month growth rate that has fully moderated back down after the initial flurry that was very temporary, as I always said all along. The 2-month growth rate that is also moderated back down. The 3-month growth rate that is also moderated back down. The 6-month growth rate that is already halfway down to its normal zone. And the 1-year growth rate that has already peaked and is starting to go down, and everyone looks at the 1-year growth rate because that is apparently the only window of time that matters. When the 1-year growth rate of the US CPI is high, then people say that inflation is high. But when the 1-year growth rate is not high, then the same people are nowhere to be found. So let's take an annualized standardized measurement across all these various time snapshots to get some uniformity. So this is a table that I introduced last month, and I've updated it for this month. As we saw, the 1-month inflation growth rate is 0.1%, but if you take that up to an annualized measurement, so to the 12th power, you get 1.2%. The 2-month growth rate is 0.5%, but if you take that to a 1-year annualized growth rate, which is to say to the 6th power, you get 3%. The 3-month growth rate is 0.9%, but annualized, that is 3.6%. The 6-month, which we saw, is 2.4%, annualized 4.9%, and the 1-year growth rate is 7.1%. It happens to be the highest number in this entire table because any time window less than a year shows much lower inflation than the headline media would have you believe. And any time frame greater than a year also shows a low annual inflation rate. In fact, the 10-year, as we saw, which is just 2.6%, also is followed by the 5-year, which is 3.7%, and so forth. So only right now is the 1-year inflation rate high, even though it's already past its peak. It used to be 8 point something before, now it's down to 7.1. And obviously, it is very unusual for the 1-year inflation rate to be the highest within all these time windows. Usually the magnitude of the number might be very unevenly distributed among these time windows, and this red number, the 1-year, is getting pushed down to be within the zone of these others as well. In fact, the shorter term inflation is declining so quickly, that's why you have these lower numbers in the shortest window of time frame. If 1 month had only 0.1%, then a year has 1.2%, which is quite low. So despite everything you hear about inflation was 7.1% and it's raging out of control, no, nothing could be further from the truth. The peak was several months ago and it's already declining very quickly. So why is the Federal Reserve tightening still? Well, for that you'll have to see other videos on this channel. But no, inflation is not high, nor is it rising in a second derivative. It has already peaked and has been in decline for a few months already, and we are getting back down to a low inflation rate. In fact, we may even dip into deflation, and then the Federal Reserve will have to resume quantitative easing and lower the Fed funds rate again. But to be worried about inflation now is quite innumerate, and this data really reveals how that is yesterday's news, to put it mildly. Inflation peaked quite a few months ago and was never going to stay very high for a sustained period. As I have said all along, the atom thesis, the first principles of technology and economics, made this an easy prediction to make. The amount of money printing that can be done without aberrantly high inflation is much higher than people think, and we have just witnessed this over the last 12 years as well as over the last 2 years, and this will continue to manifest. Now, if you found this video to be informative and you like this type of content, then I encourage you to subscribe to this channel. Thank you very much for watching.